On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. Let's run through last week's key developments, then let's turn our attention to what's coming up in the days ahead. Tough week last week for global share markets. We obviously had fresh tariff developments that came out through the week. Then on Friday, we saw a much weaker than expected jobs report in the US, and that spooked investors. The S&P 500 index in the US was down 2.4%, European shares were down 3.3%, UK shares down 0.6%. A lot of that weakness came on Friday. Markets in this part of the world fared better, but that's because we were closed when that news came out about the jobs report on Friday, so we might play a little bit of catch up come Monday morning. Japan and Australia only marginally lower, and the NZX 50 here in New Zealand was down 1%. And a lot of that was because of negative sentiment that we saw after a soft trading update from Mainfreight at its AGM. Mainfreight was down about 10%, 11% over the course of the week, and because it is a big stock, a very high profile stock, and if it's struggling, then that does suggest the economy is still struggling. That really did just put a dampener on the local market. So we were off 1% on the back of that. Interest rates, the US 10-year Treasury yield fell sharply on Friday. It was down 16 basis points, which is quite a big fall. That's the biggest daily fall we've seen in a year. And that saw it end the week at 4.2%, which is the lowest we've seen in 3 months. Now, here in New Zealand, the 5-year swap rate was barely moved at 3.5%. But remember, our market was closed during that US trading session. So you would expect us to open on Monday and for wholesale interest rates to come down a little bit. Right, turning to some of the key events and releases, and it was a big week for central banks, and the Federal Reserve in the US was very much the headline act. The Fed left interest rates unchanged, so the Fed funds rate upper bound is at 4.5%. It reached 5.5% in 2023 and 2024. That was the highest that we'd seen since 2001, and the Fed has reduced it 100 basis points since then. Most of that came late last year. They've been on hold in 2025, and they stayed on hold, but it was still an interesting decision. They actually voted on this one. They always vote, but what was interesting about this vote was that you had two people that advocated for a cut. So they dissented, and you don't often see dissenting votes at the Fed. They're quite rare, and the last time that we saw two members dissent was way back in 1993, so that was pretty interesting. There was no new set of forecasts, no new projections, so all we got was the statement, then the press conference. In that press conference, Chair Powell did note that the central bank was watching for the potential impacts of tariffs and what they might mean for inflation. So I think that is really what is holding the Fed back from cutting interest rates. They're just worried about tariffs and what they might mean for inflation. They did say no decisions have been made about the meeting in September. However, odds for a rate cut in September have been moving around a lot. They came down after this Fed decision, which came out on Thursday morning New Zealand time. It was a little bit more hawkish than expected, so traders were out there saying, well, maybe we won't get that rate cut in September. But after the jobs report, which came 2 days later, early hours of Saturday morning New Zealand time, those odds have surged to 88%. So now markets see a cut from the Fed in September as much, much more likely. And markets are actually pricing in 61 basis points of easing this calendar year, and that suggests we'll get at least 2 25 basis point cuts and that there's a decent chance for a third. So it would have been interesting if this jobs report had come out before the Fed decision. That would have made things really interesting, wouldn't it? But the Fed obviously wouldn't have seen it when they met earlier in the week. Right, we'll get to the jobs report, but first inflation, because we did see the PCE inflation measure, personal consumption expenditures, that was out for June, and it actually picked up. It increased 0.3% for the month at the headline level and at the core level. What that meant was that the annual headline PCE rose 2.6%. Slightly above forecast for 2.5 and the highest in 4 months. The core PCE increased at an annual rate of 2.8%. That was also slightly higher than expected, and it was in line with the previous month. So a little bit of upward pressure on inflation. We're still in the twos in the US, but it has been creeping up a little bit, as we've seen here in New Zealand. Right, on Friday, that is where we got a swag of negative economic releases. It was the jobs report and it was the ISM manufacturing index. The ISM index was weaker than expected in July. It fell to a 9-month low of 48. People were expecting it to come up to 49.5, which would have still been just below that break-even 50 level, but 48.0, much lower, weakest in 9 months. New orders were also pretty disappointing. They came in below expectations. So the only real bright spot that I saw was an unexpected fall in the prices paid index. That came down to the lowest since February. That's a good indicator of inflation. It was expected to go up. Instead, it came down. So I suppose that is at least one positive. We'll get the services ISM on, I think, Tuesday next week. So hopefully it looks a little better. Then there was the jobs report, and this was really weak. We only saw 73,000 new jobs created. Forecasts were for about 104,000. But what really got the market's attention were the revisions. So you got those 73,000 new jobs in July, but June and May were revised sharply lower. So when you put those 3 months together and add up all the jobs, you've only got 106,000 now over that 3-month period. And that's the weakest 3 months that we've seen since the COVID lockdowns. And if you exclude that period, because it was sort of weird and artificial and not reflective of, a BAU economy, if you exclude that period, it's the weakest 3 months that we've seen since 2010. When we were coming out of the GFC. So that is why markets took notice of this. You saw share markets lower, you saw interest rates tumble, you saw traders bet on more chance of Fed rate cuts next month and over the balance of this year, and you saw the US dollar come off the boil as well. So it really did shake things up on Friday, and I think we'll see that continue in this part of the world come Monday. The unemployment rate increased from 4.1% to 4.2%. That was in line with market expectations. Oh, and get this, it wasn't just financial markets that were a casualty. President Trump actually fired the head of the Bureau of Labour Statistics, the BLS. That's sort of the US equivalent of Stats NZ. Fired her. Just hours after the report came out. So, that's a bit weird. He didn't like the data, so, fire the person that's in charge of the data. I don't know if that's the right solution, Don, but okay. Anyway, what did we have here in New Zealand? New Zealand business confidence, stable in July. The ANZ Business Outlook saw headline confidence edge higher from 46.3 to 47.8. That's a 3-month high. Own activity, it was little change. So even though you have got a very soft trading environment, businesses are hopeful that we will see things pick up in the months ahead. In terms of the sectors, agriculture was the most upbeat. I suppose that's not surprising. The other thing that got everyone's attention in the survey was that residential construction activity expectations slumped to the lowest we've seen in a year. On the inflation front, most indicators softened, which is good, with firms' pricing expectations falling to a 7-month low, so largely as expected. Right, turning to the week ahead, and internationally it will still be all about trade and tariffs. The new US tariffs are set to take effect on Thursday, that's the 7th of August. It was the 1st of August, but you've had some technical implementation delay that has pushed those out to the 7th of August, so that's Thursday. Then you'll see those new rates take effect. Remember, it's 15% for us. We thought it would be 10, but it's going to be 15, and I think that's the case for a lot of countries too. However, I suppose between now and Thursday, because of that delay, the door has been left ever so slightly ajar for a couple more deals to be announced over the next few days. So we'll see. Maybe we will get 1 or 2 more deals. But trade and tariffs will be a major theme again this week. The central banking highlight will be the Bank of England's monetary policy decision. This is on Thursday, and markets are expecting another rate cut. The BOE left its policy rate unchanged at the last meeting in June, having reduced it from a 15-year high of 5.25% to 4.25%, 4.25%. So we're at the lowest levels since 2023. We're seeing 4 cuts, expecting the 5th cut to 4% this week. So that's on Thursday. It's priced in to the tune of about 96, 97%. So very much seen as a done deal. And then beyond that, markets still see further cuts from the Bank of England. So their policy rate expected to fall to 3.5% by March next year. Here in New Zealand, a couple of things to watch on Wednesday. Early that morning, we will get the results of the latest dairy auction, so that'll be interesting. At the last auction, we saw the index rise 1.1%, the headline GDT index, that is. That was the biggest gain we'd seen since early May, so that's good news. We saw solid gains from whole milk powder, skim milk powder, so hopefully we will see that strength continue because there was a 4-auction losing streak that we saw before that last one, so it's been a bit volatile. But early Wednesday morning, we'll get the latest dairy auction results. Later on Wednesday, and this will be the highlight of our week, we will get the labour force report for the June 2025 quarter. That's out at 10:45 a.m. and it's expected to see the unemployment rate rise from its current level of 5.1% to 5.3%. That would be the highest that we've seen since the end of 2016. And that will be a little higher than what the Reserve Bank is expecting too. I think they've got 5.2% penciled in. So economists expect it to come up a little bit more than that, 5.3%, highest in 8.5 years. So this is the last key release ahead of that upcoming RBNZ decision late this month, in late August. I think the 20th of August it is from memory. And at the moment, markets see about an 80% likelihood of another 0.25% cut to the OCR, which would see it come down to 3%. So I think if economists are right and you do see a bigger increase in the unemployment rate than the Reserve Bank is expecting, and if it is indeed the highest that we've seen since 2016, I think that would seal the deal on that OCR cut at the end of this month. I think they'll cut anyway, but that would really just lock that in for the end of this month. Also, the reporting season, that will continue. We've got more than 100 S&P 500 companies set to announce results this week. The earnings season is about 2/3 of the way through by number of companies, and it's been pretty good so far. More than 80% of companies have exceeded earnings estimates, and the earnings growth rate for the June quarter relative to the same quarter a year earlier, and this is for the S&P 500 index in the US, the big one, the earnings growth rate is sitting at 10.3%, which is well above what people were expecting a few weeks back before the earnings season started. So 4.8% was what people were picking then, and it's more than double that, 10.3. So that is a great outcome. Obviously, not every company has done fantastically well, but most of them have, and there have been some cracking results, and there will be a lot more companies that are reporting this week. Who have we got? Let me just check my calendar. We will hear from Caterpillar, Diageo, Zoetis, Disney, Emerson Electric, McDonald's, Novo Nordisk. That will be a really interesting one. Novo Nordisk, that is the big European healthcare giant that makes those weight loss drugs, Ozempic and the other one, always forget the name. But it had a trading update last week, or it pre-announced its quarterly result. And the stock fell more than 30% over the course of the week because, the update wasn't a great one. So people will be watching that one to see if there's any more information or if we see any sort of rebound. Shopify, Eli Lilly, Sony, Toyota. So lots going on, trade and tariffs, many more corporate results, hopefully a rate cut in the UK, and our own labour force report. No one wants to see the unemployment rate rise. We'd rather see it stabilise and then fall. But I guess one silver lining, if it does go up as expected, is that it will almost guarantee that we will see the OCR come down again later this month. And that's what we need because the economy needs a little bit more stimulus. It's still very tough out there. So thanks for listening, team. Hope that was useful, and we'll talk again soon.
For more insights, visit craigsip.com.